Hello friends, welcome to LU Update. In today's video, we are going to discuss the most important MCQs for the subject Income Tax Law and Accounts for BCOM 6th semester. Now these 80 questions are most important for your semester exams. So please prepare them very well. So starting with the questions, the first question that we have is the Income Tax Act extends to. Now, the Income Tax Act extends to the whole of India, including the states of Jammu and Kashmir and Sikkim. Therefore, the correct answer is option A, that is whole of India. Income Tax Act जो आपका होता है उसे कोई फर्क नहीं पड़ता कि आप जम्मू एंड कश्मीर में हैं, आप सिक्किम में हैं या कहीं पे भी हैं. If you are a part of any Indian state, then the Income Tax Act is levied on you. Now the next question that we have is CBDT stands for. अब CBDT किसके लिए stand करता है? So our options are Chief Board of Direct Taxes, Central Board of Direct Taxes, Central Board of Duplicate Taxes, and option D, none of the above. So the correct answer is option B, that is Central Board of Direct Taxes. It is a statutory authority that functions under the Department of Revenue in the Ministry of Finance, Government of India. CBDT is the one responsible for administrating direct tax laws and ensuring the effective and efficient functioning of the Income Tax Department. So, for question 2, your correct answer is option B, Central Board of Direct Taxes. Now moving on to next question. The question says, as per section 2, subsection 7, assessee means a person. Your given options are option A, by whom any tax or other sum of money is payable. Option B, against whom proceeding has been taken under the Act. Option C, a person deemed to be assessee in default, and option D, all of the above. So, the correct answer is option D, all of the above. So, as per section 2, subsection 7 of the Income Tax Act, assessee means a person by whom the tax or sum of money is payable under the Act, against whom proceedings under the Act has been taken for the assessment of his or her income or the income of any other person in respect of which he is assessable, and a person deemed to be an assessee in default under any provision of the Act. Therefore, an assessee can refer to any person who is liable to pay tax or any other sum of money under the Income Tax Act, someone against whom a proceeding has been initiated for assessment, or a person deemed to be an assessee in default. So the correct answer is option D, that is all of the above. Next question that we have is a person includes. Now under Income Tax Act, what does a person includes? So as per the Income Tax Act, the term person includes an individual, an HUF, a firm and company, association of persons, AOP, BOI, and every AGP. Therefore, the term persons in the context of Income Tax Act includes individuals, HUFs, firms, companies, AOPs, BOIs, LAs, and every AJP. Hence, the option D, that is all of the above, is the correct answer. So, for question number 4, your correct answer is option D, all of the above. Moving on to next question, that is the assessment year is a period of 12 months commencing on first day of. Now, the correct answer among the given options, your options are option A, April every year, option B, December every year, option C, July every year, and option D, January every year. So, for question number 5, the correct answer is option A, that is April every year. The assessment year is a period of 12 months commencing on the first day of April, that is 1st of April every year. It follows the financial year which runs from 1st April to 31st March. During the assessment year, taxpayers file their income tax returns for the previous financial year and their income is assessed for tax purpose by the tax authority. So, assessment year starts from 1st April and ends on 31st March. Next question that we have is, a person follows calendar year for accounting purpose. For taxation, he has to follow. Your options are calendar year only, that is 1st January to 31st December. Financial year only, that is 1st April to 31st March. Any calendar or financial year as per his choice. Or option D, he will follow extended year from 1st January to next 31st March, that is a period of 15 months. So the correct answer is option B, that is financial year only from 1st April to 31st March. Now for taxation purpose in India, individuals and businesses are required to follow the financial year for the accounting period. The financial year runs from 1st April to 31st March of the following year, and it is the standard accounting period specified by the Income Tax Act for reporting income and filing tax returns. Therefore, option B, that is financial year only from 1st April to 31st March, is the correct choice for taxation purpose. Now, the next question that we have is, Income Tax Act was passed in which year? Your options are 1934, 1956, 1961 and 1972. So the correct answer is option C, that is 1961. The Income Tax Act was passed in the year 1961. It is the primary legislation in India that governs the levy, administration, collection and enforcement of income tax. The Income Tax Act 1961 replaced the earlier Income Tax Act of 1922 and has been subsequently amended multiple times to incorporate changes in tax provisions and regulations. Now, Income Tax Act came into force on. Your options are 1st April 1935, 1st April 1961, 1st April 1962 and 1st April 1956. So the correct answer is option C, that is 1st April 1962. Now, Income Tax Act was passed in the year 1961, but it was not in force until 1962. So when Income Tax Act came into force was on 1st April 1962. Moving on to next question, that is income tax is a. Now what kind of tax is income tax? Professional tax, direct tax, indirect tax or service tax? So the correct answer is option B, that is direct tax. Now income tax is classified as a direct tax. Direct taxes are those taxes which are levied directly on individuals or entities based on their income, wealth or profits. In the case of income tax, it is imposed on the income earned by an individual, business or any other entity. It is called a direct tax because the liability to pay the tax falls directly on the taxpayer who is responsible for calculating and filing their income tax returns and paying the tax directly to the government. Hence, income tax is a direct tax. Now moving on to next question. Income tax rates are fixed in. Your options are Income Tax Act, Finance Act, Income Tax Rules and Finance Rules. So the correct answer is option B, that is Finance Act. Now income tax rates are fixed in the Finance Act. It is an annual legislation passed by the Parliament of India to approve the budgetary proposals presented by the government. It includes provisions related to income tax, customs, excise, and other fiscal matters. The Finance Act determines the income tax rates, tax slabs, exemptions, deductions, and other tax-related provisions for a particular financial year. Therefore, any changes in income tax rates are typically announced and implemented through the Finance Act passed by the Parliament. Therefore, income tax rates are fixed in the Finance Act. Now, there are dash heads of income. Now, how many heads of income are there? Your options are 3, 4, 5 and 2. So, the correct answer is option C, that is 5 heads. Now, what 5 heads of income are there as per Income Tax Act? So, at first we have income from salaries, income from house property, profits and gains from business and profession, capital gains, and income from other sources. So these are the main 5 heads of income as per Income Tax Act. Now what happens is income from salary. What does they include? It includes income received as salary, wages, commission and allowances. Income from house property includes income earned from owning a house property such as rent received from letting out a property. Profits and gains from business and profession includes income earned from a business or profession, including self-employment, freelancing or any other form of business activity. Capital gains include income earned from the sale of capital assets such as real estates, stocks, mutual funds, etc. And income from other sources include income that does not fall under the other 4 heads such as interest income, rental income from machinery, lottery winnings, etc. Therefore, these are the 5 heads of income for the purpose of taxation. Next question that we have is, assessment year is the period of 12 months commencing from dash every year. Your options are option A, 1st March, 31st March, 1st April and 30th April. So the correct answer is option C, that is 1st April. Now assessment year is a period of 12 months commencing from 1st April every year. It follows the financial year which runs from 1st April to 31st March. Now what happens is, during the assessment year, taxpayers file their income tax return for the previous financial year and their income is assessed for tax purpose by the tax authorities. Therefore, the assessment year starts from 1st April and ends on 31st March of the following year. So, the correct answer is option C, that is 1st April. Question number 13 asks, educational cess is charged at the rate of option A, 2%, 1%, 3% and 5%. So the correct answer is option C, that is 3%. According to Income Tax Act, educational cess is charged at the rate of 3%. Moving on to next question. Dash of Income Tax Act is related to residential status. So which section of given options is related to residential status under Income Tax Act? So your options are Section 2, Section 6, Section 5 and Section 4. So for the given question, that is which section of Income Tax Act is related to residential status, the correct answer is option B, that is Section 6. Section 6 of Income Tax Act relates to residential status or determination of residential status for individuals. It lays down the criteria and conditions based on which an individual is categorized as a resident or a non-resident for income tax purpose in India. The section considers factors such as individuals' stay in India, duration of stay, nature of their income to determine their residential status. Now, the next question asks, the agricultural income includes. Your options are income from sale of crop, income from preparation of crop, income from nursery, and option D, all of the above. Now your correct options are, correct answer is option A, that is income from sale of crop. So income from sale of crop is included in agricultural income. Moving on to next question. The way of tax liability by taking full advantage provided by the Act is. Option A, tax management, tax avoidance, tax planning and tax evasion. Now, टैक्स लाइबिलिटी का फुल एडवांटेज लेने का जो तरीका होता है, द वे ऑफ टैक्स लाइबिलिटी बाय टेकिंग full advantage provided by the act is. Among the given options, the correct answer is option C, that is tax planning. Now, tax planning क्या होता है? Tax planning refers to the legitimate and lawful process of organizing one's financial affairs in a way that minimize tax liability within the framework provided by the tax laws. It involves utilizing various provisions, exemptions and deductions or incentives provided by the tax laws to optimize tax benefit and reduce the overall tax burden. Now, tax planning is considered a legitimate and accepted practice that includes individuals and businesses who undertake this planning process to ensure compliance with tax laws while minimizing the tax liability. Hence, the correct answer is option C, that is tax planning. Now, next question. Total income of a person is determined on the basis of his. Now, how are you going to determine the total income of a person liable for tax payment in India? So, your options are residential status, citizenship in India, both A and B, and option D, none of the above. So, the correct answer is option A, that is residential status. Now, the total income of a person is determined based on the residential status of income tax for income tax purpose. Now, the Income Tax Act in India categorizes individuals into different residential categories such as resident, non-resident, or resident but not ordinary resident. Now, the residential status is determined by considering factors such as duration of stay in India during a financial year, number of days stayed in India over a specified period, and other relevant criteria. Now, talking about the option B, that is citizenship in India, it is not a determining factor for calculating total income. It is a residential status that plays a crucial role in determining the taxability of income for individuals. Therefore, the correct answer is option A, that is residential status. Now, the period of 12 months commencing on 1st April every year is known as. Your options are option A, the previous year, option B, the assessment year, option C, the accounting year, and option D, the financial year. So, the correct answer is option D, that is financial year. The period of 12 months commencing on the 1st day of April every year is known as the financial year. It is also referred to as the fiscal year. The financial year is used for various financial and tax related purposes including income tax calculation, budgeting, financial reporting and government fiscal planning. The financial year in India starts on 1st April and ends on 31st March of the following year. Now, the previous year means the financial year immediately preceding the Your options are accounting year, assessment year, all of the above, or none of the above. So the correct answer is option B, that is assessment year. Now the term previous year refers to the financial year immediately preceding the assessment year. It is the year in which the income is earned and assessed for taxation purpose. The income earned during the previous year is considered for assessment and is subsequently taxed in the assessment year. Therefore, the previous year is connected to the assessment year and not the accounting. Now, we have got a list for next question and you have to match the list. Now, list 1 has section 6, subsection 1, clause 1 and section 10, AA, section 10, subsection 1 and section 10, subsection 5. And in list 2, we have agricultural income, leave travel, concession, resident and leave salary. The options are as follows, that is from list A, section 6, it is for agricultural income. Section 10 AA, it is for leave salary. Section 10 subsection 1, it is for resident. And section 10 subsection 5 is for leave travel concessions. So as such, these are the following options. And the correct option for the following list is, that is option D. That means your section 6 clause 1, it is related to resident and section 10 AA relates to leave salary. Section 10 subsection 1 is related to agricultural income and section 10 subsection 5 relates to leave travel concession. So the correct answer is option D. Moving on to next question, that is income from salary involves income from. Now there are certain options given. Option A, salary, allowances, perquisites and all of these. So the question, that is income from salary involves income from. Your correct option is option D, that is all of these. Now income from salary involves income from various components such as salaries, allowances and perquisites. Salary includes the regular salary or wages received by an individual or the services rendered as an employee. उनके अगेंस्ट जो भी remuneration or wages ने salary या payout मिलता है, all these are included in this salaries. Now allowances are additional payments provided to employees to cover specific expenses or as a part of their compensation package. Some common allowances include HRA, DA or travel allowance, etc. Perquisites, also known as perks or fringe benefits, are non-monetary benefits or facilities provided by employers to employees in addition to their regular salary. Examples of perquisites include rent-free accommodation, company car, medical facilities, etc. Therefore, income from salary encompasses income from salary, allowances and perquisites received by an individual as a part of their employment. Hence, the correct answer is option D, all of these. Now, agricultural income is exempted from income tax under which of the following sections of Income Tax Act 1961? Your options are 2, subsection 1, clause A, section 10, subsection 1, section 10, subsection 2 and section 10, subsection 4. So the correct answer is option B, that is section 10, subsection 1. Now, agricultural income is exempted from income tax under the section 10, subsection 1 of Income Tax Act 1961. This section specifically provides an exemption for agricultural income earned by individuals or Hindu undivided families. According to this provision, any income derived from agricultural operations carried out on land located in India is not considered as taxable income for income tax purpose. It is important to note that the exemption is applicable only to agricultural income and not to the income earned from any other sources. So the correct answer is option B, that is section 10 subsection 1. Now, next question that we have is, income tax was imposed for the first time in India by Lucas Pacioli, Sir Newton, Sir James and Sir James Wilson. Now, the correct answer is option D, by Sir James Wilson. James Wilson was a British economist and one of the founders of British insurance company called the Standard Life Assurance Company. He also served as the finance minister in the Council of India and introduced the concept of income tax in the country. In 1860, the first Income Tax Act, known as the Income Tax Act of 1860, was passed, which levied income tax in India. James Wilson played a significant role in the introduction and implementation of income tax in India during the colonial period. So the correct answer is option D, James Wilson. Question number 24. SES is a PGT 2004. Your options are surcharge on any tax, an additional tax on luxury goods, a temporary arrangement for receiving revenue, and none of the above. So the given options, the correct answer is option A, that is surcharge on any tax. In the context of taxation, a surcharge is an additional charge or levy imposed on the existing tax liability, usually applied as a percentage of the tax amount. Now, cess typically refers to a type of levy imposed by the government for a particular purpose, such as education, health, infrastructural development, or specific welfare initiatives. The purpose and applicability of cess can vary depending on the specific legislation or government policy in place. Therefore, the correct answer is option A, surcharge on any tax. Now, question number 25. Income from sale of land is or am? Your options are non-agricultural income, cost, expense, and none of these. So the correct answer is option A, that is non-agricultural income. Now, income from sale of land is considered non-agricultural in the context of taxation. Agricultural income typically refers to income derived from agricultural activities such as farming, cultivation, or agricultural operations. However, income from sale of land, regardless of its usage, is generally treated as non-agricultural income for tax purpose. Now, it is important to note that classification of income as agricultural or non-agricultural may have specific legal definitions and can vary based on jurisdictions of specific tax laws. But in India, sale of land is considered a non-agricultural income. Now, moving on to next question. If an assessee is engaged in a business of growing and manufacturing tea in India, the portion of agricultural income in that case shall be. Your options are 100%, 60%, 50%, and 40%. So the correct answer is option B, that is 60%. Where an assessee is engaged in a business of growing and manufacturing tea in India, the portion of agricultural income is considered to be 60% of total income. As per section 115 BBE of Income Tax Act 1961, for individuals and Hindu undivided families engaged in tea manufacturing, 60% of the total income derived from the sale of tea produced and manufactured by them is considered agricultural income. The remaining 40% is considered as non-agricultural income and taxed accordingly. Now moving on to next question. Which of the following deductions will not come under Section 80 of Income Tax Act 1961? So, Section 80 of Income Tax Act 1961 provides for various deductions, and the following options are: deductions in the case of a person with disability, deductions for interest paid on loan taken for pursuing higher education, deduction for interest on loan taken for construction purchase of house property, or deduction for repayment of any installment of principal amount borrowed for the purchase or construction of house property. Now, Section 80 of Income Tax Act provides for various deductions available to taxpayers. However, specific deductions mentioned in option C, which is related to interest on loan taken for the construction or purchase of house property, does not fall under Section 80 of Income Tax Act 1961. Instead, it is covered under a separate section, that is Section 24, Clause B. So, the correct answer is option C. Deduction for interest on loan taken for construction or purchase of house property does not come under Section 80 of Income Tax Act 1961. Now question 28. Any amount of money received in excess of 50,000 without consideration is fully taxable in the hands of, your options are individuals, individuals and HUF, individuals, HUF and company, and option D, all assessees. So the correct answer is option B, that is individuals and HUF. So any amount of money received in excess of 50,000 without consideration is fully taxable in the hands of individuals and HUF. Moving on to next question. According to Income Tax Act, which of the following is agricultural income? Your options are income from animal husbandry, income from poultry farming, income from pasture, and rent received from agricultural land. So the correct answer is option D, that is rent received from agricultural land is considered as an agricultural income under Income Tax Act 1961. Now, the salary received by the manager of an agricultural farm is option A, a profession income, agricultural income, capital income, or income from salary. So, when a person is employed as a manager of an agricultural farm and receives a salary for their services, it is categorized as income from salary. The nature of their employment and salary received falls under the scope of income from salary as defined in Income Tax Act 1961. Therefore, correct answer is option D, that is income from salary. Now, question number 31. Determine the status of Lucknow University, a local authority, a body of individuals, a firm, a joint Hindu undivided family, or an artificial judicial person. So, the status of LU would be option E, that is artificial judicial person. Now, LU is a government funded educational institution established by an act of Uttar Pradesh State Legislature. As an educational institution, it is considered an artificial judicial person under the law. Artificial judicial persons are entities created by law and have legal recognition and rights similar to natural persons, but they are not individuals or human beings. Therefore, the appropriate status for LU would be an artificial judicial person. Now, income received in India in previous year in the hands of income received in India in the previous year is taxable in the hands of resident, non-resident, non-ordinarily resident, and all of these. So the correct answer is option D, all of these. Now, under the provisions of Income Tax Act, income received in India in the previous year is taxable in the hands of residents, non-residents, and not ordinary residents. Now, residents of India are subject to tax on their worldwide income, including income received in India. Non-residents are liable to pay taxes on income received in India or income occurring or arising in India. Their global income, excluding income from Indian sources, is generally not taxable in India. And not ordinarily residents. Now, these are individuals who are not residents of India in either of the preceding years and have been in India for less than 730 days. In the preceding 7 years. Non-ordinarily resident are taxed similarly to non-residents, which means their income received in India or income occurring or arising in India is taxable. Therefore, all three of these are taxable in the hands of Income Tax Act. Therefore, the correct answer is option D, that is all of these. Now, next question asks, person is defined under section. Now, under which section of Income Tax Act is person defined? Your options are option A, section 2, subsection 31, option B, section 2, subsection 36, option C, section 1, subsection 9, and option D, section 2, subsection 45. So your correct answer is option A, that is section 2, subsection 31. The definition of a person is provided under section 2, subsection 31 of Income Tax Act 1961. It defines a person as including an individual, HUF, a company, a firm, AOP or a BOI, a local authority or any artificial jurisdictional person not falling within any of the preceding categories, and any other person capable of being taxed under Income Tax Act 1961. Therefore, section 2, subsection 31 of Income Tax Act provides the definition for a person for the purpose of income tax in India. Now, next question. The rental income received by a foreign individual in respect of property situated in Delhi is taxable in the hands of. Your options are resident and ordinarily resident only, ordinarily resident or not ordinarily resident only, non-resident only and ordinarily resident, not ordinarily resident or non-resident. So the correct answer is option D, that is ordinarily resident, not ordinarily resident, and non-residents. Now, under the provisions of Income Tax Act, rental income received by a foreign individual in respect of any property situated in Delhi or anywhere in India is taxable in the hands of all these three category individuals. Because ordinarily residents are liable to pay tax on their worldwide income, therefore, rental income received by an ordinary resident, foreign individual from a property in Delhi would be taxable in their hands. Not ordinarily residents are those individuals who do not meet the criteria of being resident or originally resident in India, they are taxable in India on their income that is received or accrued in India, or income that is deemed to be received or accrued in India. Therefore, the rental income received by a not originally resident foreign individual from a property in Delhi is taxable in their hands. Now, talking about non-resident individuals are taxable in India only on income that is received or accrued in India, or income that is deemed to be received or accrued in India. Rental income received by a non-resident foreign individual from a property in Delhi would fall under the scope of taxable income in India. Therefore, the correct answer is option D. For rental income received by any foreign individual in respect of the property situated in Delhi is taxable in the hands of originally resident, not ordinary resident, and non-resident. Next question. An Indian citizen who goes abroad for employment shall have to stay in India for at least how many days to be a resident? Your options are 182 days, 90 days, 60 days, and 180 days. So the correct answer is 182 days. That is option A. So according to the provisions of Income Tax Act, an Indian citizen who goes abroad for employment purpose will be considered a resident in India if their stay in India is for at least 182 days or more during the relevant financial year. Now, this criteria is applicable to determine the residential status of an individual for income tax purpose. If any individual or any Indian citizen meets the conditions of staying 182 days in India or more, they will be considered a resident and their global income will be taxable in India. If they do not meet this condition, they may be classified as non-resident or resident but not originally resident, depending on other factors such as their stay in India in the previous years. Therefore, correct answer is option A, that is 182 days. Now, income from business in England, which is controlled from India, is taxable. Your options are resident, extraordinary resident, non-resident, and option D, both A and B. So, for the question, income from business in England, which is controlled from India, is taxable. Your correct answer is option D, that is both A and B, resident and extraordinary resident. In both these cases, any income from business in England, which is controlled. So with this, your part A of most important MCQs for income tax laws and accounts has been completed. I hope the video was helpful and we will upload the next part very soon. Thank you.